The era of low interest rates has come to an abrupt end in Britain, and the cost of living crisis is about to get a lot worse for many mortgage holders. Thousands coming off of fixed rate deals agreed when rates were historically low are in for a major financial shock. Is Britain's mortgage system a time bomb waiting to go off? Welcome to Roundtable. I'm Philip Hampshire. The UK's based interest rate stood at 0.25 of 1% at the beginning of last year. Today, it's 5% and likely to rise higher. For many, the spike is yet to feed through to their monthly payments on their house loan, but the number of people being affected is going up every month, and the pain is severe.
The vast majority of mortgages in Britain are fixed-rate deals. Typically, a lower rate is fixed for either 2 or 5 years. Borrowers then either have to remortgage or go on to their bank's standard variable rate, which is much higher. As many as 800,000 households will see their fixed rate end by the close of 2023, with another 1.4 million by December next year. Customers have enjoyed historically low rates for years, but in less than 18 months, the average 2-year fixed mortgage has gone from 1.95% to more than 6%. The difference between those numbers is literally hundreds in extra payments every month. Many will be left simply unable to pay and may potentially lose their homes.
So is the situation in Britain worse than elsewhere? And what are the likely consequences of this mortgage cliff? Joining us to discuss this today in the studio, we have Roger Gewolb, who's a former advisor to the Bank of England and the Treasury. Meanwhile, in Lancaster, we have Dr. John Whittaker, who's an economist at Lancaster University, specialising in monetary policy, banking and financial markets. And in Oxford, we're joined by Wolfgang Munchau, who's a director of Euro Intelligence and a columnist at the New Statesman. Thank you very much, gentlemen, for joining me. Roger, I'm going to turn to you first. So, is the Bank of England doing the right thing at the moment? It's just raised interest rates up to 5%. Has it done the right thing now?
Absolutely not. I've been saying for well over a year that raising interest rates to combat the kind of inflation that we have is stupid. The United States has consumer-driven inflation. It's called demand pull, not to get too technical. Raising interest rates has lowered their inflation to the point where it's now less than 5%. Using the same blunt instrument against what we have, which is non-consumer driven.
You think it's cost push inflation in the UK?
It is cost push. It's non-consumer driven. People are choosing between heating and eating. Millions of people. It's just dire. Would a football manager be allowed onto the pitch with a playbook for the 13th game, which is the same as he used for the last 12 that he just lost? Inflation, core inflation, is still going up, and the MPC, the Monetary Policy Committee, and the blundering Andrew Bailey will not listen. And our government, including Mr. Hunt, who has never worked 24 hours in any financial business in his entire career, are too weak to stop them.
John, let me take it across to you. First of all, do you think the Bank of England's doing the right thing at the moment?
I think it probably can't do much else. I don't like what's happening from the Bank of England, but I don't know what else it could do.
What would you expect the Bank of England to be looking at then? Do you think this is cost-push inflation? Do you think this is demand-pull inflation? I'm going to go back to Roger in just a moment and make the monetarist case that it's all down to quantitative easing.
Oh, goodness. Let's not get onto that just yet. Can I just challenge your talk about cost-push and demand-pull?
Of course.
I think this kind of economics textbook jargon confuses people. I think that probably the main cause of sustained inflation at the moment is rising wages, as people try and catch up with the inflation that we have certainly had. Nobody wants to lose. They all want their salaries to maintain the same kind of spending value that they always had. And the unions, railway unions are quite strong. The doctors and so on are all exercising power that they can. that's what's pushing up inflation. People are going to come to realize at some point that we can't keep pushing this way. And I'm sorry, the interest rate tool is the only one I know that actually works in making some people poorer so they don't spend so much.
Wolfgang, let's bring this across to you. Where do you stand on this? Cost push, demand pull, monetarist inflation, or the inflation was just brought in by a magic money fairy?
No, I would not want my position caricatured by either of these or any of these explanations. But I also believe that the Bank of England has lately done the right thing. I feel that they should have acted sooner. The inflation overshoot has taken a long time, and what happened is that the nature of inflation has shifted over time. It started off as a shock. It was in the pandemic, and then the energy price shock that drove up prices. There was a food price inflation shock. These were external shocks, and now the response is that people are adjusting wages and companies are adjusting prices. There's no point at finger pointing at whose fault it is, whether it's the union's fault. And if I have to criticize the Bank of England, it is trying to get into this debate. This is something they should not have done. They shouldn't. It's not for the government of the Bank of England to say, it is irresponsible for wage earners to ask for more money. That is just not what he should do. If you wanted to blame anyone, blame him, not blame the workers for this. But it's we are in a situation where inflation is high, where the bank has to act. They have an inflation mandate. I know there are a lot of economists who don't believe in the inflation mandate. They have other agendas. That's fine for them, but the Bank of England does have that agenda. It's a symmetric inflation target that it needs to deliver over a period of time. It doesn't need to deliver it tomorrow, but there is a medium-term time frame. So they need to act, and the 5%, I believe it's going to go higher.
Roger, let me bring this back across to you. So neither of the other two guests think that the Bank of England is necessary. They might have been slow, but they don't think that there's a problem with having raised interest rates up to their current levels. I mean, I would put it to you that even with interest rates at their current levels of 5%, if you've got inflation in the UK, last month the CPI figures were 8.7%. If we looked at the RPI numbers, those are about 11.3, 11.4, depending on when you take your start and end points. So they're still negative real interest rates.
Not really, because if you read things like the Leeds Building Society and other similar reports, a 6.4% mortgage today is equivalent to a 25.7% mortgage, if you can even imagine that in the 1980s. My colleagues here are two of the politest gentlemen I've met. I mean, most of the criticism about Mr. Bailey and the Bank of England, I actually understand, just between us, that he confidentially is having secret meetings with Stop Oil. He's trying to learn how to glue himself to the seat at the Bank of England. I mean, the man is under siege. So many people feel that he's wrong. It isn't wages that is driving inflation. It's a combination of factors. It's labor shortages that, of course, Remainers will claim is caused by Brexit. It is a certain amount of wage increase, but real wages, for God's sake, haven't moved in 20 years. And you're absolutely right, Mr. Munchau. How dare the governor say, and how dare other officials tell us not to ask for wage rises, and that companies should not seek to increase their profitability at the present time? Where are we? In China, in some strange province? I mean, it's just absurd. Now, to answer your question, Dr. Whitaker, in 2009, as I'm sure you know, we also had similar inflation from oil price increases and the rest, and the bank left interest rates alone. They did not touch them because cost plus push runs itself out. They are indeed, as you say, committed to this because they've now entered on this track, and nobody knows any different, and they can't admit that they're terribly wrong. But figures released recently show that the mortgage crisis that's been caused, 45% of mortgagees, that's almost 7 million people, cannot now meet their commitments. And 4% of the British public will run out of savings and money by the end of the year, according to the National Society of Economic and Research, I can't remember the name, NSEIR. So it's a dire situation created only by interest rates. It was completely unnecessary.
Okay, I'm going to pick you up there because both you and Wolfgang as well, so I'll come back to Wolfgang with this as well, have shot me down when I brought up quantitative easing. But the fact of the matter is, if we look back over the course of the last few years, I remember a meme that was put up on the internet just as we went into COVID, where somebody said, half of all the US dollars that have ever been in existence have been printed in the last 18 months.
Yeah.
And I thought, that's ridiculous. That cannot possibly be true. Yeah. And then you go and look up the numbers and you're like, oh my goodness, in ballpark, that's not that far off. So surely the problem isn't interest rates now, it isn't cost push, it isn't any of those things. It's the Bank of England gavaged. It literally stuffed money into the system.
I didn't shoot you down at all. I agree with you. It's another fact. I mean, there is some wage growth, a teeny tiny bit. There is some labor shortage, a touch of Brexit perhaps. But is it Brexit because it's a bad idea and a failure? Or is it Brexit because it hasn't been properly implemented, because the government took 2 years instead of 48 hours to sign Article 50? 150 billion of quantitative easing done at the wrong time. An oil tanker poured on an inferno.
Let me take this across. Let me bring this across to John. John, what do you say to all of that? Because there's been a lot in there and there's a lot you'll want to unpack.
Well, for sure, if we're going to get into quantitative easing, I fear that we're going to get into deep water here. This is all about the past, and quantitative easing was done a lot since the financial crisis, and my concern here is that they didn't know when to stop. During the pandemic, they carried on with quantitative easing, and with hindsight, it would have been much better had they not done so, at least not so enthusiastically. So now we're stuck with, yes, the Bank of England does own a very great deal of government debt, and the money supply, if you want to talk about that, is much higher than it should be. Fine, well, that's where we're at. I think this debate should rather be about, well, where do we go from here? And you started out this debate by asking us all, well, what would we do? And Roger had some ideas there, which I've taken some issue with. Mm-hmm. And I think Wolfgang and I probably agree that never mind what's gone in the past, we still have to keep a handle on interest rates. And that's unfortunately pushing up the mortgage rates and causing an enormous amount of distress. I'm very sorry, I don't know what to do about that. But I don't know any other tool. And the sooner we get over this, the better.
With the interest rates at the moment, we've got a chart here of interest rates in sort of major industrialized economies in the West. The only one of the major industrialized economies that hasn't raised interest rates rapidly has been Japan. Here in the UK, with interest rates going up to 5%, a lot of the UK's leverage over its economy with interest rates is tied up with mortgages. As people come off their fixed rate mortgages and they suddenly slam into 5% interest rates, are we not suddenly going to find the UK economy is looking, well, it's slowly slowing, it's slowly bringing down inflation, and then it hits a wall?
Well, this is how it works. I'm sorry, this is how we have tackled inflation in the past. It causes misery, it causes at least low growth, if not recession, but then we recover. I'll go back, if I may, to when we came out of the exchange rate mechanism, going back a few years, with the European Union. We got into that setup. There was a recession, a short, sharp recession for about 3 or 4 years, and then the economy took off nicely. There are other episodes in history where this has happened. We're in a bad place right now, but the sooner we get out of that bad place, the better.
Wolfgang, are you in agreement with that or not?
Yeah, broadly I am. I mean, I often compare the situation with the late 1970s and early 1980s, when interest rates, when people made very similar arguments about not raising interest rates in the 70s, when they made arguments about, this is just a cost push. These were oil price shocks back in those days, very similar to what happened here in this decade. And central banks kept interest rates at below the inflation rates for a very long time. And then secondary and tertiary mechanisms started to bite. Wages and prices went up. And then they had to, bear down on these interest rates. Paul Volcker, raised them. The Thatcher administration raised them in '79. So that was a period of very high interest rate, and that produced a recession. And I expect very similar to happen here. The levels will be different. A 5%, 6% interest rate will produce a lot more damage today than a 15% interest rate did in the 1980s. People are leveraged up to their necks, so we might get away with a smaller peak rate, that's for sure. But I think I think we'll probably be close to the peak in any case. And if the central banks get it wrong, and this is quite possible, this is it's very hard to forecast inflation, as we've all learned in the last year. Very hard to forecast inflation. If you get it wrong, you lower the interest rate. That is what you can do. This is better than undershooting your target all the time, being behind the curve all the time, and then keep on doing it. And this is a bit much what happened here. If they had been more decisive earlier on, we would probably have lower interest rates today.
I'm going to put that to you. If they'd started raising interest rates earlier, would you have been happy with that?
Look, I mean, I'm a consumer champion. I'm a people's champion. I'm not really very interested in economics. This is quite an act. I mean, I'm looking at you two gentlemen sitting in your fine offices. This is an academic economic discussion to which most of the people I deal with all day, would be very much. I mean, I'm dealing with people who are losing their homes. Now, Sunak and Hunt, should be more aware of this, but they're quite out of touch. Andrew Bailey, I want to say something nice. He's committed to the path he chose. He came in, after all, in March 2020, just as COVID hit. He wanted to be the savior of UK business. He wanted to keep it all going, okay? So he even went to the banks and told them to adopt negative interest so that they would lend more and boost business. He then, in November that year, did his, as you say, his quantitative easing, mistakenly throwing that 150 million out. You're all absolutely right. He didn't know when to stop, okay? He has a reputation for doing things too late. If he had stopped and started gradually raising interest rates, we would be much better off than we are today. Turning around and dumping it all on us, 13 rises in 1 year, little over a year, is insane. And I really don't think the entitled, privileged people who, quote unquote, lead us understand how the millions and millions and millions of people, ordinary Brits, are suffering. I speak to these people all the time. They don't understand. They're really not interested in anything any of us have to say. They want to know when the foot is coming off their ruddy throat. It's as simple as that. The theories don't interest them. They need to stop now. No more rises.
Let me take this across to John. John.
Yeah, Philip, I want to put a point in here, if I may, and that is how the Bank of England how it makes its decision. It's got its monetary policy committee. It's supposed to be independent. It's supposed to be working on the one mandate, and that is to keep inflation around 2%. It's clearly failed dramatically. Now, let's look a little more deeply at why that can be the case. And I want to simply make the point that you can never take politics out of the Bank of England decision. Even though the guys on the committee, guys and ladies and gentlemen on the committee are supposed to be independent, you can't take politics out of it, because and Andrew Bailey, of course, is going to be deeply unpopular when they put up interest rates. And that's one good reason why they were so slow to do it. They knew at the time that raising interest rates, even a little bit, as they did at the end of 21, beginning of 22, is going to cause trouble. It's going to cause distress. It's going to cause distress from people with mortgages, and it's deeply going to cause distress for the government, because the government has to pay a great deal more interest on the government debt. That's 2 trillion of debt or something. And I read that the interest payments on the debt have gone up to about more than 100 billion a year now. That's very expensive on the taxpayer. Now, please, what other solution is there? Let's ask the other guys, what other solution is there than to bear down on inflation, to convince people that inflation is coming down, and the only way you do that is by giving people the nasty medicine?
Excuse me, John. It is having and has had nil effect. Inflation is still increasing. How long do we have to wait to see that something doesn't work? How long does a mouse in a lab run down a channel to find there's no cheese there and then stop?
Let me throw the question back at you. What else would you do? You've
Just
talked about reducing interest rates. Reducing interest rates makes people spend more. That'll help to drive up inflation. What else would you do?
Stop raising interest rates. That's the start. I introduced 6 things that the government could do. It's on my Twitter account. And they could do it in a week, which would take a huge burden off the cost of living crisis. Number one, I hope I can remember them all. Number one, stop raising interest rates. Number two, have a temporary moratorium on VAT. Reduce VAT across the board for 6 months or 12 months. Number three, reduce fuel duty, the same. We pay a staggering amount. It's a triple tax fuel duty. There's fuel duty, there's VAT on the petrol and the fuel duty.
Isn't all of this just going to leave people with more money in their wallets and therefore stoke even more inflation?
They don't have money in their wallets. That's the point. This is what the Westminster bubble and Whitehall don't understand. There are millions and millions and millions of people who don't have any money. I want to get a coach and get some of my friends from Westminster and take them to cold beans dinners, particularly up north with people who live like that. This is way past the point of the sort of things you gentlemen are talking about.
Let me take this across to Wolfgang. Wolfgang, to what degree is the disparity and the disconnect here between the two sides down to the fact that the UK has a particular problem with its mortgage market? If I were to buy a house in the United States and take out a mortgage, I get a 30-year fixed-rate mortgage on day one or a 25-year fixed-rate mortgage on day one. If I did the same in Germany, I'd probably get something similar, whereas here in the UK, I'm on 2-year deals or 3-year deals or 5-year deals, and then suddenly the mortgage market has an overwhelming impact on the economy and the amount of spare cash.
I completely agree. This has been also a reason why it would have been very difficult for the UK to join the Eurozone. There was a discussion back in the early 2000s. A membership of the euro would have required significant changes to the mortgage market because, because we would have been in a very similar discussion that we're having here today. But we would have been, within the eurozone. People would have said the ECB, don't raise interest rates because people in northern England are losing their homes. That's not a consideration for a central bank, or should not be a consideration for a central bank that has an inflation target, because it's an area-wide objective. So the idea, we're discussing different things. We're saying, if you dispute the idea that the Bank of England should raise interest rates, you're really saying they shouldn't have a 2% inflation target, because they will. The central bank has the tools to control inflation. They might have misforecast inflation, but they can get it down, and it takes time. These interest rates will reduce inflation. It will take a year or 2 years. There is a delay between the decision you take between the decision, between the interest rate decision and the impact on inflation.
But excuse me, it won't be the Bank of England or Jeremy Hunt that does it. It's cost push, which, as in 2009, always runs itself out.
Well, hang on. If the Bank of England raises interest rates, though, it does have an impact on the value of the pound, raises the value of the pound. If a lot of that cost push inflation is coming from raw materials being purchased overseas, that should actually bring down the inflation rate.
How's that working out, the pound?
Not especially well
It's not
right
protecting
now.
the pound any more than it's preventing inflation. I know that Andrew Bailey meant well, being thrown into the middle of all this as COVID started. He wanted to save British business. But all this time later, man, it's not working. It's simply not working, and people have to admit it. You can't stay on the same course for years and years with people suffering the way they are.
But I think that what the other two gentlemen are saying is that it will work and there will be a decline. After all, the Bank of England has an inflation mandate, unlike the Federal Reserve in the United States.
If inflation comes down, as some were predicting some weeks ago, to 3.2 or 2.7% in the winter, it won't be because anybody did anything. It's because it's cost push. Food prices are dropping, fuel prices are dropping. Wagner would have gotten rid of Putin, or something else will happen. He'll stop manipulating the market. One of my other 6 points is the biggest cost of living in our cost of living crisis is the home energy bill. 2/3 of our home energy bills is electricity. 100% of that electricity is priced off the international market price of gas, based on idiotic conventions adopted in the 80s when the energy companies were nationalized, which no government, not just this one, has seen fit to remove.
Let me take this back across to you, John. John, if we are going to see a decline come through in the inflation numbers, and it comes through in the winter, is there not simply going to be because costs have come down elsewhere? If we look at Spain at the moment, it's only got an inflation rate of about 1.7% because it's mostly producing its food domestically, for instance. So leave it alone, inflation will come down on its own.
Well, I'm afraid that's not the history of what's happened over the last couple of years, is it? And I'd like to see Mr. Gavold deny the fact that wages are still rising. And for me and for the Bank of England, in their many discussions about this, they lay the blame on current levels of inflation very much on wages rising. Now, is that part of his cost push? Probably, yes. Well, if you bear down on people sufficiently, maybe they won't ask for such high rises in wages. There will be less demand.
Gentlemen, I'm really sorry, but we're running out of time for the show. But it's been an absolute pleasure to have all three of you on. It's been a fantastic and rather fiery debate today. Remember, you can see more discussion and debate if you head on over to our YouTube channel, though. Just head on over to YouTube and search for Roundtable TRT World. But for now, from me here and the entire team, thank you for watching, and goodbye.